So, you want to buy a wind farm. Free fuel forever, blowing in whenever it wants, turning into electricity you get to sell. Here's the part nobody tells you. The wind is the one part of this business you'll never have to worry about. Everything else, the contracts, the interest rates, the grid itself, can sink a wind farm before a single turbine ever spins. That's not a contradiction. That's the whole business, and once you understand what actually determines whether a wind farm makes money, you'll never look at a turbine on the horizon the same way again. Let's start with what it actually costs to build one, because the number scales in a way most people don't expect. Onshore wind construction typically runs somewhere in the range of $1,300 to $1,700 per kilowatt of installed capacity. A mid-sized 200 megawatt onshore project, a fairly ordinary size in this industry, lands you somewhere around $260 to $340 million before a single blade has turned. The largest onshore wind farm in the United States, the Alta Wind Energy Center in California's Tehachapi Pass, was built across 11 separate phases between 2010 and 2014, with just the first phase alone requiring a $1.2 billion financing deal backed by Citibank, Barclays, and Credit Suisse. Go offshore and the economics change entirely. Offshore wind construction costs roughly $4,000 per kilowatt, more than double the onshore figure, because you're not just building turbines, you're building foundations that have to withstand ocean conditions, specialized installation vessels, and subsea transmission cable running back to shore. Here's the number that actually determines whether any of this makes sense, and it's called the levelized cost of energy, or LCOE. It measures the average cost per unit of electricity a project needs to generate over its entire lifetime just to break even, folding construction costs, financing, and decades of operation and maintenance into a single number. For onshore wind in the United States, LCOE typically runs somewhere between $24 and $51 per megawatt hour, depending heavily on how windy the specific site actually is. This makes onshore wind one of the cheapest sources of new electricity generation in the country, competitive with natural gas even without subsidies. Offshore wind tells a very different story. LCOE for offshore projects typically runs between $72 and $140 per megawatt hour, sometimes exceeding $120 unsubsidized, 2 to 3 times the onshore figure, for all the same reasons construction costs run higher out at sea. So say you've built it. Where does the revenue actually come from? Almost entirely from selling the electricity itself, and the mechanism that makes this predictable is called a power purchase agreement, a PPA. A wind farm operator signs a long-term contract, often running 20 to 25 years, locking in a price per megawatt hour with a utility or a large corporate buyer. This is the single most important document in the entire business because it converts an asset that generates a genuinely unpredictable amount of electricity, some days windy, some days still, into a revenue stream that looks, on paper, remarkably stable. The Alta Wind Energy Center signed a 20-year, 1,550 megawatt agreement with Southern California Edison, at the time the largest wind energy contract any American utility had ever signed. That single contract is what allowed the entire 11-phase project to get financed in the first place. Without a buyer locked in for 2 decades, no bank writes a check for a billion-dollar wind farm. Layered on top of the PPA is a second, less visible revenue source, government incentives, and in the United States, the most important of these has historically been the production tax credit, worth roughly 2.5 cents per kilowatt hour of electricity actually generated for the first 10 years a project operates. For a large wind farm, this can add tens of millions of dollars in value annually, and for years, entire projects were financed with the explicit assumption that the tax credit would make the difference between marginal and genuinely profitable. Utility-scale wind projects, once you combine the PPA revenue with tax credit value, typically target an internal rate of return somewhere between 7 and 12%. A return profile attractive enough to draw pension funds and infrastructure investors who want predictable, long-duration cash flow, not explosive growth. Now, here's what determines whether that return actually materializes. And it isn't how big the turbines are. It's something called the capacity factor, the percentage of time a wind farm actually generates electricity at its full rated capacity, accounting for the fact that wind, unlike a power plant burning fuel on demand, only shows up when it shows up. Onshore wind farms typically achieve a capacity factor between 38 and 47%. Offshore wind, benefiting from stronger, more consistent ocean winds, can reach 41 to 50%, sometimes higher. This single number, decided almost entirely by where you chose to build, has more influence over a wind farm's lifetime profitability than nearly any other variable in the business. Build in a genuinely windy corridor, and the same turbine that struggles elsewhere becomes a reliably profitable asset. Build somewhere the wind doesn't reliably show up, and no PPA, no tax credit, and no amount of engineering will save the project's economics. Then there's the cost side, and while wind farms have famously low fuel costs, since the fuel is free, they are not low cost to operate. Offshore projects in particular carry operations and maintenance costs that can run more than double their onshore equivalents, largely because sending a repair crew out to a turbine sitting in open ocean is an entirely different logistical undertaking than driving a truck to one standing in a Texas field. And every wind farm, onshore or offshore, depends on something almost nobody outside the industry thinks about at all: transmission. Generating electricity in a remote, windy location does nothing if there's no way to move that electricity to where people actually live. The Alta Wind Energy Center's completion was contingent on Southern California Edison building an entirely separate $1.8 billion high-voltage transmission project just to carry the power out of the Tehachapi Pass and onto the grid. That's a cost larger than most entire wind farms, spent purely on the infrastructure to deliver power nobody could otherwise use. Here's the trap that has derailed more wind projects in recent years than almost anything else, and it has nothing to do with the wind itself. When you finance a wind farm, particularly an offshore one, you're borrowing enormous sums against a PPA price that was locked in years before construction finishes. If interest rates rise, if steel and turbine costs climb due to supply chain disruption, if the timeline slips by even a year or two, your financing costs balloon while your revenue, locked in by that fixed-price contract, stays exactly the same. You cannot go back to your utility buyer and ask for more money because construction got more expensive. The contract that made the project bankable in the first place becomes the exact thing that traps you when costs move against you. There's a story that shows how quickly this can turn an enormous, well-financed project into a multi-billion-dollar write-down. Ørsted, the Danish company that is, by most measures, the largest offshore wind developer in the world, had spent years developing two major projects off the coast of southern New Jersey called Ocean Wind 1 and Ocean Wind 2, with a combined planned capacity of more than 2,200 megawatts, enough to power roughly 500,000 homes. Ocean Wind 1 alone involved 98 turbines planned 15 miles off the New Jersey coast, with construction due to begin in the fall of 2023 and commercial operation targeted for 2025. In late October and early November of 2023, Ørsted announced it was ceasing development of both projects entirely. The company's chief executive cited, in his own words, significant adverse developments from supply chain challenges leading to delays in the project schedule, combined with sharply rising interest rates. Ørsted also said it had failed to secure the level of tax credits it had built into its original financial model. The total impairment tied to the cancellation came to approximately $4 billion, with $2.8 billion of that figure attributed to Ocean Wind 1 specifically, a project that, only months earlier, had been expected to begin construction within the year. New Jersey would have gotten its first offshore wind farm. Instead, it got nothing, and Ørsted walked away from a project it had already invested years and billions of dollars developing, because the economics that made sense when the PPA was signed no longer worked once financing. Costs and material costs moved sharply against the company. Here's the structural lesson underneath that story. Ocean Wind 1 wasn't canceled because the wind off the New Jersey coast stopped blowing, and it wasn't canceled because the technology failed. It was canceled because the fixed-price contract signed years earlier could no longer support a construction budget that had grown well beyond what anyone modeled when the deal was struck. The same mechanism that makes a PPA valuable, locking in predictable revenue for decades, becomes a liability the moment your costs move faster than that locked-in price can absorb. Now compare that to a project that, despite an equally long and complicated development timeline, actually made it across the finish line and kept expanding for years afterward. The Alta Wind Energy Center in California's Tehachapi Pass began development amid genuine skepticism about whether it could ever get built at all. The project's completion depended entirely on a transmission line that didn't exist yet, and regulatory delays pushed the timeline back repeatedly through the mid-2000s. But once Southern California Edison committed to that 20-year, 1,550 megawatt power purchase agreement, the largest wind contract any American utility had signed, the project had exactly what Ocean Wind never secured before costs turned against it: a long-term revenue guarantee locked in early enough, and a construction timeline that, while delayed, wasn't derailed by a sudden spike in interest rates or steel prices. TerraGen Power closed a $1.2 billion financing deal for the first phase in 2010, backed by major global banks willing to lend against that 20-year contract. Additional financing followed for later phases, as the project expanded across 11 total phases between 2010 and 2014, eventually reaching 1,550 megawatts of installed capacity, enough to power somewhere between 375,000 and 500,000 American households, and remaining the largest onshore wind farm in the country for years afterward. The difference between these two outcomes wasn't the ambition of the project or the skill of the developer. Ørsted is a far larger, more experienced offshore wind operator than TerraGen was in 2010. The difference was timing and location. Alta's onshore construction costs and timeline were less exposed to the kind of offshore-specific cost inflation, specialized vessels, ocean foundations, that hit Ocean Wind particularly hard. And Alta's financing closed years before the interest rate environment that ultimately doomed Ørsted's New Jersey projects. The exact same financing structure, a long-term PPA supporting a large construction loan, worked perfectly for one project and became a trap for the other, entirely because of when each one happened to lock in its numbers. That brings us to the structural risk sitting underneath this entire industry, and it isn't the wind, and it isn't even the technology. It's the multi-year gap between signing a fixed-price contract and finishing construction, a gap during which interest rates, material costs, and labor costs can move significantly, while your revenue, locked in by contract, cannot move at all. A wind farm is, in financial terms, a bet that your construction costs will stay roughly where you modeled them when you signed a power purchase agreement that won't budge for 2 decades. When that bet goes wrong, and offshore wind in particular has seen it go wrong repeatedly in recent years, the project doesn't just underperform. It can get canceled entirely, with billions of dollars in prior development spending written off completely. Zoom out across the industry, and the pattern becomes obvious. The wind farms that succeed over the long run are almost never the ones betting on the newest, most ambitious technology in the most difficult conditions. They're the ones built in genuinely windy locations with strong capacity factors, financed with PPAs locked in during stable interest rate environments, and constructed on timelines short enough that the gap between contract signing and commercial operation doesn't leave much room for the world to change underneath them. The wind farms that fail are almost always the ones caught in that gap, watching costs climb while a fixed-price contract prevents them from passing any of that increase through to their buyer. So does owning a wind farm actually work as a business? The honest answer depends almost entirely on timing, location, and the length of that exposure window between signing a contract and finishing construction. In the optimistic version, you build in a location with a strong capacity factor, lock in a long-term PPA during a stable financing environment, and complete construction close enough to that signing date that costs haven't had time to drift meaningfully away from your original model, the way Alta Wind Energy Center did across its 11 phases, becoming one of the largest and most durable wind assets in the country. In the realistic bad version, you sign a PPA years before construction finishes, interest rates or material costs move sharply against you during that gap, and the fixed-price contract that once made your project bankable becomes the exact mechanism that makes it impossible to complete. The same trap that turned Ørsted's New Jersey projects into a $4 billion write-down before a single turbine was ever installed offshore. Neither outcome has much to do with how much wind actually blows across the site. A wind farm was never really a bet on the weather. It's a bet on whether the gap between locking in a price today and finishing construction years from now stays small enough and stable enough for the numbers you signed up for to still make sense by the time the turbines are finally ready to turn.